What's up, guys? Stacy here from Becoming Financially Fit, and today we're going to be talking about an interesting topic. In episode 3 of Money Talks, the podcast, one of my friends came to me with the question of should he take a loan from his 401k to pay off some of his credit card and other debts. So today we're going to be talking about the pros and cons of taking a 401k loan. So let's get into it. Before we get into the content, I make videos about personal finance, financial literacy, savings, investing, and also we try to throw some entrepreneurship in there as well. So if you're interested in these topics, make sure you subscribe to the channel and don't forget to hit the bell to be updated anytime I post new content. So in one of my last discussions, the question arose of if one of my friends should take out money from his 401k to pretty much consolidate some of his debt that he had and use it to pay off that debt. And I had some pros and cons to that, so we're going to get into all of those topics. But just to start out, what exactly is a 401k? A 401k is a retirement account, usually provided by your employer, and you actually put money into it. It's what you call a defined contribution plan. So you put money into it over the course of your working career, so whether that be 40, 50 years, right? And then at the end of that period, when you're ready to retire, you're supposed to have some type of lump sum available for you to get yourself through retirement. And usually a lot of people's goals is to hit $1 million, but that balance at the end of the day can be different for everyone depending on your lifestyle or how much money you actually want to spend every month in retirement. So we're going to get into all of that, but I don't want to confuse this with a pension plan. And a pension plan is what you would call defined benefit. And what that means is that back in the day for our parents or our grandparents, if they were to go to work for a company, they would work for that company for, let's say, 20 or 25, 30 years. And if they hit those milestones, then the company that they actually worked for would provide them this retirement benefit. So it could be, let's say, $5,000 a month forever until they were to pass away. And this was very, very popular back in the day because it incentivized a lot of people to work and just stay in the same company year after year. But now things are different. And those things were really hard to actually finance for companies because they were seeing that as people live longer and longer, their liabilities for those pension plans were going through the roof. So what they did was they defined some type of other account, a 401k, where it lets the employee actually put in a certain amount of money and they can actually match that. So we'll get into that a little bit. And then when they hit retirement, they wouldn't have to depend on the company. They could just depend on whatever was in that 401k retirement account. So now the question arises, should you use a 401k loan to pay off credit card debt or other debts that you have outstanding? And for most people, well, it all depends on your situation. So before we get into if you should actually use your 401k to take out a loan to pay off some of those outstanding debts, let's actually define what a 401k loan is. And it's actually you borrowing money from your 401k investment account. And you're not borrowing it from a company or anything like that or a bank. You're actually borrowing that money from yourself. And depending on your plan, you can usually take up to, let's say, 50% or maybe 25%. Like I said, it all depends on your particular plan, but you can take out a lump sum of money. I think it's up to $50,000 depending on your plan, but I think that's the max from the IRS. And what you can do with that money is it's super simple. What you can do is you can log onto your plan, and like I said, this depends on your particular plan. And you can actually fill out an application online and get that money within, let's say, 2 to 3 days. And this is great for a lot of people because sometimes they're in a crunch and they need this money to actually pay off debt or to purchase something. So they've made it really easy for you to access your money from these 401 accounts, but it comes with a lot of pros and cons. And we'll get into both of those just to make sure you guys are aware of all of the consequences or benefits of taking money out of your 401k. Now, just so everyone is aware, even though you're taking money away from yourself, essentially, you still have to pay this back. And depending on your plan, you're probably going to have to pay it back with interest as well. So it's not like a free money loan. You have to actually pay it back with interest. But the good part about paying this interest is that you're essentially paying yourself interest. So some of the pros of this is When you take the money out, let's say you take out $5,000, you may have an interest rate of 5%, maybe 7%. And this all depends, like I said, on your particular plan. So make sure if you're thinking about taking a 401k loan out, make sure you read through all of your plan documents to know exactly what you're getting yourself into. But that's one of the pros. Even though you're taking the money out of your investment account and you're not gaining that money in the stock market, you're still going to be able to get a little interest while you're paying yourself back. Another pro of a 401k loan is the fact that, like I said, it's almost instant capital. It usually takes about 30 minutes to an hour to actually fill out the application. And more often than not, they won't check your credit. You won't have to actually fill any additional paperwork. You just say the amount you want to take out. You submit the button, and within a matter of 2 to 3 days, that money will be sent to you in your bank account through an ACH, or if you want to do the traditional route, you can actually get it through the mail, and they'll actually send you a hard copy check, and you can go deposit that into your bank account. And one of the things 401k loans are very, very good for is paying off high interest credit card debt, or high interest debt that you have in other places that you want to consolidate into one payment. And this is going to be good because let's say the average credit card rate can be upwards of 20 to 25%. So if you don't want to continue paying that high interest credit cards and you actually want to consolidate it down to maybe something that only costs you, let's say 4 or 5%, a 401k loan would be a great idea to pay off those old debts and actually consolidate it. One of the other benefits of a 401k loan is the fact that you can actually use that money for whatever you want to. But I would recommend using it to pay off outstanding debts, but they also do offer other options. So let's say you want to purchase a house, you can use it to purchase a house. Let's say you want to buy a car, you can do that. Or you want to pay for college or pay off student loans, you can also use it for that. Once you get the money into your account, you can use it for anything you want to. But just make sure you know that when you actually take the money out, you have a defined period where you pay back that loan over the course of, let's say, every 2 weeks for 1 year, 3 year, 5 years. You can pick that out as you go, but it will actually tell you the amount of time. And like I said, depending on your plan, the max may be 5 years if it's just for something that's personal, or it could be up to 15 years depending on your plan if you want to use that money for something like the purchase of a primary residence. So now let's get into some of the cons of taking out money from your 401k. The first of which is the fact that you have to pay it back. Even though it's technically your money that you put into this account, you always have to pay that money back. And the fact that you have to pay this money back with after-tax cash makes it very, very hard for some people, because when you're putting it into a 401k, that's tax deferred. So it's not really hitting you hard in the form of taxes. But when you're putting that money back into the account and actually paying off the 401k loan, you're using after-tax money. So the money has already been taxed and it comes directly out of your check back to pay off that loan. So you're actually getting less buying power with the money that you're taking out. Another con for some people is the fact that it comes directly out of your check. So let's say you get paid every 2 weeks or bi-weekly or monthly. No matter what happens, the first thing that your company will do is take that money out of your check. So even though you're getting a lump sum of cash, you still have to pay that money back. And your company is going to want that money up front. So what they're going to do is, before you even receive your direct deposit or your check for working there for every 2 weeks, or like I said, every month, they're actually going to take that monthly payment out and use that to fund your 401k loan. And so this is good and bad. It's an automated payment plan that comes directly out of your check, but you will see your actual after tax, your net income from each check go down significantly depending on the balance that you take out of that 401k loan. Another thing that a lot of people don't think about is the fact that it is a loan and you can default on that loan. So let's say you, for some reason, lose your job or you can't make those payments anymore. It's going to be a defaulted loan. And what that means is that you won't be able to take any other loans out of your 401k until you pay that back. And what this means for tax purposes is that you have to pay the tax on the amount of money that you took out. And not only do you have to pay the taxes, which could be upwards of 20 to 30%, you also have to pay a 10% penalty, and it goes directly to the IRS. So there are some huge tax consequences to taking out a 401k loan and defaulting on it. So I want to make sure you guys are aware that this can be a risky thing to do. Another thing that I will say about 401k loans is the fact that you're actually taking money out of the stock market. And even if you're only getting, let's say, 10% in the stock market or 7 or 8%, you're actually going to be losing that potential gain, that potential interest that you're getting in the markets while you're using it for other things. And like I said, if you're using it to pay off high interest debt, then it might be a good thing to do. But just be aware that you're going to be taking money out of the stock market. So let's say if the market goes on a rally of 20 to 25%, you're going to be losing out on the gains you could have gotten because you took the cash out to use it for something else. Wrapping up the cons, I want you guys to be aware that taking out 401k loans is essentially borrowing money from your future to pay off things that you did in your past or to purchase things in the present. So make sure you're aware that this could have a huge impact on your current or your future earnings in that 401k account. So make sure you're weighing out all the pros and cons when you're actually thinking about taking out a 401k loan. So now that we weighed some of the pros and cons of a 401k loan, when is it a good time to take one out? I would say you should definitely think about doing something like this if you have outstanding bad debt, and that's in the form of high interest debt. If you can use some of those funds in your 401k to pay off that debt and actually get a lower interest rate when you're paying it back to yourself, that's a great idea, because not only are you going to be saving on interest, but you're also going to be able to raise that credit score because you're paying off some of that old debt. I would highly advise, though, if you're using the funds to pay off old debt, like credit cards or personal loans or a car, make sure that you close out all of the other debt accounts that you have, so you're not going to be racking up more and more debt in the future. And this is something that a lot of people don't do. And what they do is they use the money from their 401k to pay off, let's say, a credit card, but then they run that money up on the credit card again, and that's no use, because now not only do you owe money for your 401k loan, but you also owe money on that credit card again. So I would highly advise, if you're using this money to pay off old debts, make sure you close out those old accounts. 401k loans are also a good idea if you have a bunch of small accounts that you're trying to pay off, and maybe you're struggling with a minimum payment because it's spread out over 5 accounts or maybe 6 accounts, and you want to just consolidate that loan. And this is good for individuals who may not have the best credit or bad credit, because when you're actually taking money out of a 401k loan, more often than not, you won't have any type of credit check, and you can use it to consolidate that debt. But like I said, it's always a good idea, if you're taking a 401k loan to consolidate that debt, make sure you're closing out those old accounts. One other thing to mention is the fact that 401k loans can be used to purchase a primary residence, or they can be used to purchase investments. But I would just highly suggest that you do your research before you actually go into making a purchase of, let's say, a primary residence, or to put it into some type of investment, because like I said, you're gonna have to pay this money back, and sometimes if you default, you will have to pay super high taxes on it. So if you're using it to get a primary residence, try to do something that's maybe an investment, maybe a duplex or a threeplex, even a fourplex, because not only are you going to be able to use those funds to actually buy an asset and generate some income in the side, but you're also going to have somewhere to live, and that's always a good thing, to invest in yourself and actually consolidate some of that interest and be able to purchase some other high ticket items. But what do you guys think? If you guys are thinking about taking out some type of 401k loan, drop a comment below and let me know if you have any questions about the process. I would highly advise you guys look at your plan documents to see all of the things that come with taking out a loan from your 401k. There can be a lot of good and a lot of bad, but I hope you guys got some value out of this. If you like the content that I'm putting out, make sure you give this video a like, and don't forget to subscribe to the channel and hit that bell to be updated anytime I post new content.